So how much deposit or what sort of deposit do I need to buy a house is a common question we get every day. Now, if you're looking to utilise the first home guarantee scheme, so in Queensland, that's a property price cap at the moment of $1 million in Southeast Queensland and $700,000 for the rest of the state. You'll get away with just 5% of what you're looking to purchase plus your purchasing costs. Now, by purchasing costs, we mean stamp duty if it's applicable, solicitors' fees and registration costs. In Queensland, at present, up to $700,000, there is no stamp duty. So if you're buying something for $700,000, you need 5%, which is $35,000, plus your solicitors' fees, legal fees and registration costs, round figures about another $5,000. There is another option which is known as a family guarantee or family equity loan. So we've put an example of what that looks like on the screen now for you. Now, this is not the old guarantor loan that most of our parents or older generation remember, which is we can't afford the loan, so let's throw the parents on so we can get it. The borrowers have to stand on their own 2 feet when it comes to affording the loan, having the borrowing capacity, and being in a position for the bank to say, yes, we're happy to lend you that amount. Where the guarantor comes in is we're using equity in their property where we can actually borrow up to 100% of the purchase price, and some lenders will even include purchasing costs in that amount. How it's structured, as you can see on the screen, is 80% of that, or $640,000, is secured against the borrower's property. The remaining 20%, or in this case $160,000, is secured against the borrower's property, but also the guarantor's property. That gives the lender enough security so that they're happy to lend 100% of the purchase price, and like we said, can even lend 100% plus purchasing costs. Now, it's up to the borrower to meet the repayments on the loan. The guarantor's not a servicing guarantor, so if the borrower misses a repayment, the guarantor's not going to get a tap on the shoulder and say they're $800 short this week, can you please cough it up? How a guarantor will come into it is if the borrower run away, go broke, doesn't pay, then the bank will come and sell their property first. If there is a shortfall, that's when the guarantor will get a tap on the shoulder. Now, this is not a long-term solution. So we want to release this as soon as possible. Now, for the borrower, ideally, once the debt level sits at 80% of the value of their property. Now, in this instance, if they paid $800,000 for the property, once their property increases to, say, $1 million in value, if the debt sits at less than 80% of that, or 800, then the guarantor can be released. Now, at that time, it's not a full application. They're not borrowing any more money. All the lender's checking is what's the valuation of the property? Is that equity there, or is the debt level sitting at 80% of the value? If so, they sign a form and off they go. Really popular way for people to use the bank of mum and dad where no cash or money changes hands, but they use that equity that they built up in their property over years to help their kids get into the property market. There is a security or a mortgage on the guarantor's property. In the example that we use, that's $160,000. That's not a financial liability for the guarantors. So if they go for another loan, they don't have to declare that as a loan they have to repay. It does, however, chew up $160,000 equity in their property. So if they're looking to use that property for further lending while this guarantee is going to be in effect, they just need to know that that $160,000 is going to be used. They can sell the property, but something needs to be done with the loan. Usually what happens at that time is we go back and we get a new valuation on the borrower's property. We borrow as much as we can to try and soak up that $160,000 loan. If there is a shortfall, they can still sell the property, but they just have to pay that portion of the loan out, and there's an IOU to the parents in the background. If you're a first home buyer and you're looking to purchase without the first home guarantee scheme, the minimum deposit you'll get away with is around about 10% of the purchase price. So 5% covers your deposit, the other 5% covers your lender's mortgage insurance, because if you're not part of that first home guarantee scheme, unfortunately you've got to pay lender's mortgage insurance unless you have a 20% deposit, and the registration and solicitor's costs. So not an exact, but something to aim for.